Okay, so when the Plaza Accord did happen, the yen and Dutch mark actually increased in value relative to the dollar. And that made the US dollar depreciate by 25.8% in the 2 years that followed. And that's why, from this, remember, because partially the fall in money supply, that was a big reason why the market declined like this. And this was in March, hang on, this was in 80 September 22nd, 1985. Okay, so that was actually 2 years ago. That led to a boom. But then in 2 years, that's when that declined in the currency because the currency didn't just fall down immediately. That probably happened yeah, exactly. That you can see here. See, like the US dollar depreciated by 25% 2 years after it happened. So from the Plaza Accord, the US dollar dropped sharply. Wait, so the initial fall in the dollar actually began months before the accord was implemented, but the accord reduced but did not eliminate the US Japan trade deficit, although it did significantly reduce the US deficit with Germany. Not all of the policy goals were met, but the overall goal of weakening the dollar to ease the US trade deficit worked. Now, this is important because this is what led to the Louvre Accord. The US current account balances as a percentage of GDP stabilized between 1985 and 1987, and then rose to actually achieve a slight surplus by 1991. We're going into why they replaced the Plaza Accord. By 1987, the Plaza Accord had mostly achieved its desired effect, and the US government did not desire further weakening of the dollar. So that's pretty funny. The US economy, mostly the government, wanted to weaken the dollar, but the Plaza Accord worked too well, or it weakened the dollar too much. And so to fight against that, it's like another problem from the opposite side. They had to close Plaza Accord and reopen another agreement, which was called the Louvre Accord. And this was signed in 1987, primarily now to stop the continuing decline of the dollar and stabilize exchange rates. So the Louvre Accord was implemented to partially reverse the policies carried out the Plaza Accord. Exactly. So it reversed, it did the opposite of what the other one was doing. The other one was trying to depreciate the dollar. Now they're wanting to strengthen the dollar, but not to a big amount. You see how this is all like back and forth? But then this is what killed Japan. The US and Japan kept their monetary pledges, and the five nations agreed to step in if their currencies moved outside of a set range. Now, Japan and the Plaza Accord solidified Japan's presence as a major player in the international market. But an unintended consequence of the accord, however, was that it caused Japan to increase trade and investment with East Asia, making it less dependent on the US. Yet a rising yen may also have contributed because there was a recessionary pressure with Japan's economy. And the strong yen led to a major short term shock to Japanese export based industries. So, in order to offset these effects of the shock, the Japanese government embarked on a massive campaign of expansionary monetary and fiscal policy in a bid to boost the domestic economy. So, let's rephrase this because maybe this might be a bit technical for some of you. So, one of the things was from the accord, Japan decided to increase its trade with East Asia. But that's not good because it made it less dependent with the US. Now, looking during this period, remember that the yen was rising. So the yen was rising because primarily from a recessionary pressure that was going on in the Japanese economy. So while there was a US trade deficit, the Japan was going through a recession. And the strong yen led to a major short-term shock to a lot of the Japanese companies that are constantly exporting items to other countries. So in order to offset this shock, the Japanese government went on to make a massive campaign to make a expansionary monetary and fiscal policy to boost domestic economy. So they basically wanted to boost a lot of the economic activity in order to reduce the negative impact it had on exporting items because they had a strong yen, but from a unproductive reason, from a recession. You don't want that to be the reason out of it. I'm pretty sure this is confusing the hell out of people who are macroeconomics or even people not. But just try to bear with me. I know a lot of this is a bit technical, but I just want you to understand that even in such things that maybe might seem so big to you, like this, the Japanese economy or whatever, the market goes down. It does, but it always goes up the next years later. And that's why you don't invest in macroeconomics, right? I think I've said that maybe thousands of times, but I just I really love doing all this stuff because it really proves to you how, let's say, sluggish it is to invest on just macroeconomical and how unreliable it is. That's why I don't invest in macroeconomics. I know a lot of people do, and that's perfectly fine. There is people, there has to be people who are doing different things, but you're not going to get the fabulous results by investing in macroeconomic, and you're definitely going to get probably going to die earlier because you're trying to predict something that is so highly complex that really doesn't have a major impact in what it is. But whatever. The massive macroeconomic stimulus in combination with, now it is very important if you're in the Federal Reserve. Don't get me wrong. But I'm just saying in terms of investing and buying businesses and getting a better return for you don't need to do macroeconomics. You don't even need to listen to it at all. You should actually use it. That's why I'm trying to educate all this to you, not because it's important, because it's going to help you invest. It is going to help you invest because you're going to be doing things other people aren't doing, that they're listening to this junk. So then you can analyze it in a way and see it as an opportunity to buy. Because I want to give you countless of examples to know how big of a problem this really is. And even though it's such a big problem, it still doesn't affect the markets in the long term. And it shows you how useless it is to invest that way. So I'm really trying to change your chip about this, because it's not, it's a bunch of bull to invest this way. But you know, when you slap in math and you think it has a lot of value, a lot of people tend to like that, right? That's why Wall Street makes money, because they get a lot of people who have high IQs with big degrees and give a high prediction about something so simple, and everyone, you know, when you tell someone that this is magic and everyone believes it, people like that, because no one's going to want to invest in something when you tell them that it makes a 4% gain a year. People want to know that it's going to make potentially a 50% gain and it's going to change the world. This would be great, these things, because humans like that. Humans do not like to be sometimes completely rational, and that's very dangerous. You always want to fight that against your life, at least for investing. You're not going to be successful. You're always emotional, which is really being a victim of what comes to you. That's why I always say that investing does not require high IQ, and it never will. It's not about being smart. It's about doing things that other people don't want to do. It's about having the right temperament and seeing things clearly for yourself when others don't. That's why Benjamin Graham said iconically that you are neither right because the crowd agrees with you or disagrees with you. You are right because your facts are right. And that's the big problem, like in politics, right? That's why I don't like to get into politics. You got to have this mindset in the world that when you don't agree with something, I don't agree with a lot of things, but that's why I do so well. You have to understand to say no to a lot of things. That's super important. If you want to do well in this game, you got to learn to say no to a lot of it, because a lot of things are junk. A lot of people like to sell junk because they think it's magic when it's not. And sometimes you hurt their feelings, but you have to be very rational and have this deep understanding with yourself that no matter whatever close person you have to you, that they're not going to influence you in what you have. Of course, it's better. I was lucky to have my parents, to have both my family involved in this category where we don't conflict in these ideas. But I have a few friends that unfortunately don't have this case. But if you don't, it doesn't matter. It's just what I said. You have to have that set of mind. But if you let other people influence your decisions, you know, you got to deserve that you're not going to do very well. It's a bit harsh, but it's just the way how it works. It's like dying. There's more possibilities of when you get into a crash that you're going to die. And many people don't like to think about that, but it's just basic common sense. It's okay. That was a bit of dry. Let's go to the next topic. So the massive macroeconomic stimulus in combination with other policies created equally massive credit and asset price bubbles in Japan. So going back to Japan, the recession that came in led to a strong yen. That strong yen made to a short-term shock in exports for industries in Japan. In order to reduce this shock, the Japanese government made a campaign to expand monetary and fiscal policy in order to boost domestic economy. So this massive economy with other policies created massive credit and asset bubbles in Japan's financial and real estate markets through the late 1980s. So then by the time this bubble burst, Japan experienced a prolonged period of low growth and deflation lasting through 90s and 2000, and that's why it was called the lost decade. And that's why I said that this was the final nail in the coffin that killed Japan, because of how Japan reacted with this. It's interesting to understand because you start to see like what works and what doesn't. Now, out of this, you can see that all these problems that happened, that Japan had a free fall here, but not until the US was doing fine temporarily. But from this big decline was the bonds, inflation, the Louvre Accord, which, right, this drawdown, when was the Louvre Accord? Okay, it was signed in 1987. So I was here. So this must have been when the Louvre Accord was created, because people, most of all, realized by this point that the US dollar was too weakened, right? So many people were probably fearful because they probably thought of inflation immediately, and to control that. And they would have to raise interest rates. So when interest rates rose, anticipating raising interest rates, coming from the stagflation about 8 years ago, when you have those people still investing plus computerized trading where all of them are selling now accurately, this is what you get. A lot of selling volume, pessimism immediately in the charts, but from this factor of computerized trading, they factor it quickly with a sharp decline. And what do you have to do here? You buy, right? You buy. And what happened later? From something macroeconomical, the market went up. It had ups and downs, it went up and down. But net in total, when you buy at the low price, kiss goodbye, and because you're likely not going to be able to see it again. At least there's an 80% chance you won't. And that's the mindset you have to have in the market. You have to value every crisis that comes in. That's why I don't know if you guys heard of that crises are absolute opportunities. And that's definitely true because they give you bargains that you might not ever get in your lifetime. That's why you want to make sure that you have cash. And you never want to buy when the price is going up irrationally up because it's likely that it might go down, right? But it can keep going up, but not for long. Right, so out of this, I think we understood what happened. There was a lot of things that happened. You had the Plaza Accord, you had Black Monday, where computerized trading, inflation, high interest rates, Japan's economy free falling, the US dollar now depreciating more than what it wanted to, money supply going down. So you have about 6 reasons. And primarily the reason all this drawdown was from the US dollar weakening too much now when there's high inflation, most of all higher interest rates, and now Japan's economy. So put that all together, you get pessimism like that. But pessimism never lasts. When you sell more, it's less likely that a worse thing will happen. So net in total, you have buying, and that's what happened. You had a prosperous period on 88, 89, markets were up. Now it's at 2,800. Now it's at 3,000. And now we're in 90. Okay, so by 89, this is now when Iraq invaded Kuwait, which was the spark of another oil crisis in August 1990. So let's look at that, which was the Persian Gulf War. The U.S. entered in a recession in 90, which lasted 8 months through March 91. Although the recession was mild relative to other post-war recessions, it was characterized by a sluggish employment recovery, most commonly referred to as a jobless recovery. Unemployment continued to rise through June 92, even though a positive economic growth rate had returned the previous year. Relative to the recovery, recessions contributed to Bill Clinton's victory in 92 presidential election. And then the background of the causes was that by 89 and 90, the economy was weakening because of the restrictive monetary policy enacted by the Federal Reserve. From that time, the stated policy of the Fed was in order to reduce inflation, a process which limited economic expansion. Another reason, because this is never the reason the market comes down, another reason was because was a loss of consumer and business confidence from the oil crisis of 90, from the Kuwait War. Because remember that the people who have the most oil now are a lot of the Middle East, which is the Kuwait. And in that time, you had Saddam Hussein, and for some of you don't know what the Kuwait War, this is now a different subject, of course. A campaign waged by a 39-country military coalition to respond to the Iraqi invasion of Kuwait. So Iraq invaded Kuwait, and the U.S. went to war with Kuwait. This is now but it's by this. Okay, I mean, this is literally by the State Department of the government. So let's read what it says. Iraq accused the U.S. and Israel of deliberately weakening Iraq by encouraging Kuwait to reduce oil prices. So let's see. Iraq accused the U.S. and Israel of deliberately weakening Iraq by encouraging Kuwait to reduce oil prices. When Iraq began to threat Kuwait early in July 90, the U.S. staged maneuvers in the Gulf to warn Iraq against taking military actions against United Arab Emirates in Kuwait. I don't even know if I'm pronouncing that right. They began threatening Kuwait, and then the U.S. made maneuvers in the Gulf to warn Iraq with military actions against Arab Emirates and Kuwait. So, just like always, the U.S. got involved, and they started to say, "Hey, don't do this. If you do that, Iraq, we will take forceful actions," in which they did, because in that time you had a dictator, and this guy was a complete dictator. He was a Iraqi politician and revolutionary of the 5th president of Iraq from a long time, 16th of July 1979 until 2003 April 9th. And he died in 2006 because, this guy was a complete criminal. No one's a bad person by nature, but from ignorance, they tend to do very bad decisions, and when they tend to harm people because they have an extreme ideology of what they want to do. And that was people like Adolf Hitler and Stalin and Saddam Hussein and even Gaddafi. So the US staged maneuvers in the Gulf to warn Iraq against taking military actions against Emirates. So yeah, that's in terms of war. And the war wasn't the problem. It was mostly because of the oil prices. You see how the world works? Like, it's not. That's why when I hear about Russia and Ukraine and all this stuff, the market's not going to go down because of that reason. It will go down most of all. It will go down because, one, COVID of inflation. The Federal Reserve's response in terms of how they will do with corresponding with inflation, and what will happen afterwards in terms of geopolitically with a war. Like, if Putin decides, I don't know, if Putin decides to invade Czech Republic, I have no idea why, but that could be a possibility. You see, like, those are things that are beyond my control, but they're low probability. There's no reason to, but they can happen. But you have to have the independent thinking to think that, okay, if that happens, if a World War III happens next month, that's really the mindset you want to have. Because anything can happen, guys. Aliens can come down next month if they wanted to, whether you believe in them or not, right? But it has to be something uncontrollable. If aliens come down next month, will the markets go down? No, I don't think so. Unless I don't know, if aliens bombard every oil factory, like, that would cause a huge economic problem. You see how the world works, though? Because that's what happened with John F. Kennedy. When John F. Kennedy died, the markets actually went up. You see, like, that makes, to many people, that would seem completely irrational, and many people would be discouraged to be in the markets because they think it's unpredictable. But in ways, it is predictable by that nature, because you see the predictable to be unpredictable. So then you won't hence your decisions based on what you're predicting, but you're basing your decisions on what's likely probable, which is that the markets are going to go up in the long term. You see the mindset there? So that's the expectation. That's why you had the market going down in 90 because of the Kuwait War and the rising tensions here. The markets were going up. Despite that, there's probably problems going on with that war. The Kuwait War officially started in August 1990, which was, see, even here. So you can see it. The market was going through a normal correction because it goes up and down. But when the Kuwait War started, look, that was the first red candle, and it went down afterwards because of oil prices. When did oil prices get affected in 1990? There was an oil shock. Okay, so it was fears in recession and weather. Petroleum consumption fell in 90, and for first year to drop in 7 years. And gas prices went up. Yeah, and Kuwait was a rich oil country. I read a few things. This is all conspiracy, and I don't like to talk about conspiracy. That there was, some, like, always, like, dictators like to say that they always make an excuse to do their decisions. There's always an excuse that Kuwait was spying on them, and that made them invade Kuwait, like always. But it's really just a imminent power to control things. Now, I do want to say, because this is a great example, during the oil shock of 1990, what would have normally happened, I'm just saying this because this also happens many times. When there's in this example, it's a geopolitical issue, so this is a perfect scenario. When there's like a geopolitical issue like this, when there's tensions of war, a lot of the people in Wall Street or in the markets in general tend to fear and estimate and expect that the war is going to get worse, and potentially that war will affect oil prices, right? So then what a lot of the investors and the general media does is they populate this opinion in the markets throughout the news, and many people, including market makers, to bring the price down, starts to sell. Even though, let's say, if this is happening, maybe there hasn't been an oil shock, right? And then 6 months, 8 months pass, and there isn't any oil shock, and there isn't any problems with inflation or any sort of economic problems. That is a really good example, because this does happen. It doesn't happen often, but it happens rarely. But it does happen. It happens a few times during issues like that. In this case, we're not seeing this at all because it actually did affect the economy because it made gas prices rise up. But oftenly what Wall Street does is, when there's tensions of a big country that is a supplier of oil is having problems with another country, in this case Iraq, a lot of the markets start to expect and start to anticipate that from that tension, from that eventual conflict that they're going to get into war, that's going to then affect oil prices, and oil prices is going to affect the economy, and the economy of that oil price is going to affect a lot of the, let's say, oil companies, and oil companies that have supply of oil are going to start to lose money. during that year, right? And so from these anticipations, more broader towards the economy, many of the markets start to sell before any of that oil shock happens, right? This is very important that I clear this up to you guys because this does happen a few times. And this actually happened in 2022 when Putin invaded Ukraine. Of course, that affected a bit oil, but it didn't affect it, let's say, to the scale of Kuwait or even not even close to the Arab oil back in 1973, right? It didn't even affect that at all, right? The main reason why the market went down in 2022 was because of the fiscal policy, the monetary policy, and the inflation that came about in the economy. And what pushed the price down wasn't oil that time. It was actually an anticipation that that's going to broader and affect the US from inflation because Russia was going to really make it a big problem for gas prices, right? And it did. It did a bit, but not to a big amount. The biggest reason on 2022 to go down was because of many reasons, right? So that's why I go back to that again, that the more reasons the market has to come down, the more likely it's going to come down and come down quite a bit, right? But the less reasons, right? Let's say if it's just, if Putin just invaded Ukraine and we didn't have problems with inflation, the market would have likely not even go through a drawdown. Maybe some companies in oil would have come down to a pull down, but it wouldn't cause the market to come down in a drawdown or not even at all in a bear market, right? This is super important because this does happen a few times in the market history. Yeah, there was this recession of loss of consumers and business confidence as a result of the oil price shock. Gas prices went up enormously, and with a weakened economy, that made the price go down. So weakened economy in costs from consumer and business confidence from oil prices. So I think mostly affected the sector of energy companies. And in terms, this also went on in effect by the Federal Reserve restricting monetary policy, right? Monetary is relating to money or currency. A monetary policy, a set of tools that a nation's central bank has available to promote sustainable economic growth by controlling the overall supply of money that is available to the nation's banks, its consumers, and its businesses. So let's go through that again. It's a bit technical for people. It's a tool that a nation's central bank has attainable just to promote an economic growth in order to control the money supply that's available already in the nation bank. So the nation bank uses this as a monetary policy to bring more economic growth in order to control the supply of money that the bank has. So the whole goal here is to promote economic growth, to control money supply. That's what a monetary policy means. Now that could be reducing the money supply or inducing it as well. And that's what happened in COVID too. So, and then over here it just says, even though this is a weaker factor, but it said that there was a weaker economy from a tax act of 86, which lowered investment incentives to contributed to the end of real estate valuation boom in the 80s. But that's a little reason. I think most of all was just this ignorance on fear that oil will affect immensely in the next few years. And hence you had a big drawdown in the 90s and the price stayed still for the next year. Afterwards, the companies had to control. But net in total, if you bought here, when many people were fearful out of the country, the Kuwait War, right at over here, let's say, or even here or here at 2,500. You remember, guys, when it was at 496? 2,500, the price went up to 3,400. It's always going to go up. No, it's going to go up every year. No. You want to make sure to buy when it goes down, or any excuse for it to go down. Now, one key thing that's important to understand in these years is that during the 90s, in the beginning, that's when computers and software from Microsoft, but computers started to become a huge thing because people started to see the big power of computing by this era because computer was becoming more accessible towards consumers. And so many people started to see very irrationally that the computer would solve everything now. Similar to like how people think about AI, right? Because that's the nature. Sometimes when something is so broadly effective, such a good idea, it's a rich access, it starts to become a bad effect in the short term because people start to become greedy. And that's what happened to cryptocurrency, and that's what happened to AI. And that will continue to happen whatever innovation comes in. That's why I don't invest where many people think that it's going to change the world, because it's always going to be in a bubble. And that bubble will always burst. As long as I'm buying something cheap intrinsically, I don't care whether it's in a bubble, because I know in the long term, the business is going to make more despite what's going on in its industry, because there's actual value there. That's the mindset of an investor. But during these years, you had many people having this huge euphoria about computers. And so the markets really went up because you had similar, like in cryptocurrency, everyone bought everything that had the name was involved in computers And this is where a lot of the unprofitable companies started to come about that were basically asking this very ridiculous offer. And many people bought them because they thought they were going to change the world just because they were named .com. So this was really now the start of the .com bubble when it started to happen, where many banks even got involved into it. Many, like George Soros, got involved into it. You see, even intelligent people that have a high net worth sometimes do a lot of stupid things. That's why I always say, and even to me, when a person like me or anyone else, when they invest into something, that does not mean at all that that should be a reason that you should invest. So just because I invest into one company does not mean that you should invest in that company, because you don't know if I'm wrong or whether I'm right, right? Because you have to do the due diligence if that's a fact or not. But it's a fact not because I make it to be a fact, but it's already a fact, right? It's like energy. I'm not saying that energy is completely important because it helps with that and in many different things. It's already been important. I didn't make it to be important. It was already important. I just found it out, right? It was already there always. And that's the mindset you need to have about that. That's why I tell people that you shouldn't invest just because other people invest into that, right? And many people give the excuse like, oh, but if Warren Buffett invests into this company and he has this years of experience, he definitely knows what he's doing. No, that's not the case. He does know what he's doing, but there's different motives. And sometimes people do stupid things, no matter how their track record is. And that's super important. That's why that's why I'm not an investment advisor, none of this stuff. I don't do these things to tell you that you should do this, but I'm giving you all the options here. And I'm giving you the effects and the ways how things move and what you want to do based on the expectations you want to do. If you want to make a lot of money, there's different ways. The easiest way is to just buy businesses. And that's why I show you that. But is it the way, and is it religiously how you need to do it? No, that's not the way how this works. If you find another way, by all means, fine by you. That's do what you're supposed to do, right? But I'm giving you this free option, this good option. That's why I wanted to create a lot of variety, because everyone has a different goal in what they want to do with this. But that's why you never want to invest because another company invests into it, because a lot of the times many people invest and they break the rules about whether something is valuable because many people think it's valuable because they see how easy it is to coin money. That's unfortunately what's happening right now with investment banking. A lot of people are becoming greedy and wanting to make fast sales because they see this mass amount of euphoria of people who don't understand the instrument to coin money fast in order to circulate commissions. It's a very scum thing to do, but a lot of people see it because they don't care whether it's scum or immoral. They just see that it's easy to make money, whether that's prostitution or Bitcoin. You see, like it's crazy, but that's the type of world that we live in sometimes. And you need to think differently from these people. So that's why I never invest, and you should never invest just because I tell you to, or just because other people tell you to. I mean, you can't tell with certainty just because I tell you something is right. I can give you my research of what it is, but I could always have something incorrectly. So you want to make sure to do your own due diligence. That's what the end of the day is. And the same thing will happen to you. If you do really well, your friend also has to do the same thing. So you see, that's why you want to always do your due diligence. I'm just giving you options, and I'm giving you companies that have a solid back check, but it's up to you if you want to invest into it. You don't need to. So yeah, that was the cause of it. After the 90s, the market went up. Now we're in 92. And from this year, really, there was a boom in the markets, but just because of this crazy irrational greed about these unprofitable technology computer companies, where anything that was named .com, people were just buying, even if they were unprofitable or they were so highly leveraged. And that was the same thing that happened with subprime mortgages and with technology companies. But it made a lot of people who bought profitable companies for their stocks go up, because everyone thinks that those companies are going to change the world. And that sometimes happens. That's why you always want to have that irrational person who's selling you, because a lot of the times they're going to offer you at such a stupid low price that at some point when the company's doing something in the industry that everyone thinks it's going to change the world, it's going to be at such a high price. And if you want to, maybe if I don't do this, but a lot of people tend to sell because they're selling at ridiculous high price than what it's worth, taking advantage of the person selling you. But that's the way how the market works into that. That was in 94. Now by 92, behind the scenes, many people don't know this, that's officially when the subprime mortgages began. I'm not talking about the boom. Many people, when they hear subprime mortgages, they think of 2008. No, subprime mortgages, so you guys can understand, subprime mortgages were actually created in order to give a person easily accessibility in order to get a loan from a bank or a lending house than a traditional bank, because it was created initially for a person who has a lower income to get a house, and I think that's good. I think that's good. But again, it went to rich access. It went to too far, similar to like computers here, where many people saw the easy money and just giving to people who are unprofitable, and that was a problem with 2004 and 2008. That many of these people investing in properties had no value, no properties selling at ridiculous prices, and where the value went to the price, and when they saw that the value wasn't the same, that's when these loans started to come down. So that's these subprime. There was no problems with the subprime mortgages, but it was the problem how people were inducing it further than what it should be to rich access, right? You never want to create a huge amount of credit just because you see that you can make a lot of money giving loans. No, that's not how finance works. You want to make something sustainable, but never think of just the money. And that's what happened, unfortunately, in 2000. Many people saw how easy it was to make money by creating these easy loans, these subprime mortgages loans to people who can, like in that movie. I don't know if you guys seen the Big Short. I recommend you to see it because we're talking about a lot of this. If you watch the movie again, you're gonna notice a lot of things you didn't because we're talking in the same language. You're gonna see that a lot of even strippers had properties and they didn't even have the money. They were able to give such a low down payment without any initial money. And how can, like, the person who's losing money there in the long term is a person lending because there's no value. And you're giving these people free amounts, and that's not a good way to run a civilization. And that's what happened with subprime mortgages. It went to rich access, and where people used it wrong, people were greedy. And when you mix greed and liquor and irrationality in a good use case for people who don't have the good opportunities, you're going to create a perfect formula for disaster. And that's what happened in 2008. So yeah, this started to become a thing. It was very small. No one knew much about subprime mortgages, but people were able to finally get a loan easily who weren't able to get it at a bank for some criteria that they were able to meet. And so that they get to buy a house more affordably. And this was a pretty productive case. But as time went on, it started to become a problem. But in these times, you had this greed on technology, on the computers. So we're in 1995. And by 1994, actually, we had the bond massacre. In 1994, and then so we can look at the economy, how the economy is doing right now. Unemployment was at 7% in 91. It hasn't been like that since 85. GDP was at 3.5%. And even look at this, in 91, it was in a recession because GDP went negative. Inflation was at 3%. However, inflation stayed the same. Now, looking at 95, which I think was the bond massacre. No, it was 94. It was on February 94, the bond massacre, which you guys will know what the hell is a bond massacre. But during this time, unemployment was not bad. It wasn't extremely high, but it was slowing down. GDP was normal. Inflation, normal. But something happened in 94. Let's go to 1994. You can see the stock market went down for only 2 months, right? The computers factor this in. That's why you see now bigger rises and sharper declines, but faster bottoms. You see, because of computers are able to fulfill the order faster. Hence bigger volumes, but bigger sells, and hence the selling to last shorter because everyone sold faster than compared to before where they had to wait to sell the next 3 days and 4 days. So you have to have this realistic factor. It makes sense. You can understand how it plays into now. But the market stayed sluggish in these years because of what was going on in bonds. Because in these years, for the past almost 2 decades, ever since stagflation, people saw that the interest rates were going to stay low. They were going to stay the same. So then, as always, when people think that something's going to stay for eternal, when someone says something and the other person says the same thing, you start to get very confident. And when you get confident, your neighbor gets confident. And when more people get into it, the more people see that it's going to last forever. And the more they're going to think of the fear of missing out, where they're going to use leverage, and it's going to be the most sustainable and attractive investment you will ever have in your lifetime. That was happening with computers, and that was happening with bonds. Of course, that's a very stupid way to go about things, and you will always lose money, and you deserve to lose money because it's not how the world works like that. Sorry, that's a harsh way, but that's just the way how it is. But the crash that happened was triggered because the FOMC on February 3rd, which is the Federal Reserve, and the February 4th, bond prices in Japan started to plummet a month earlier because of this high amount of leverage. There's also this article explaining that. So during 1993, bond market was bullish, running from a recession that plagued many industrial nations several years earlier. What happened with the J5 and Luvar Accord? There was a recession with these companies. That made long-term interest rates nearing 30-year lows after this. Because all the bad things, remember, all the bad things just ended. It's likely that another bad thing won't happen again like that very lately. But sometimes when people think like this, to the excess amount, they think it's never going to happen again. And so people start to borrow more, utilize more, and think it's never going to happen. They're living a great life until something little happens and they go bankrupt because they leverage too much. So basically, people become too greedy. With France and Germany's rates being even lower than the US at the time, European investors predicted that the short-term rates would continue to decline in 1994 and bringing with them shrinking long-term rates, which would enhance their leverage on current bond holdings. So it's the same thing what I just said. People predicted that short-term rates would decline. And so because of this, people saw, okay, this is so easy. I'm just going to use leverage then, because if it's so sure, I mean, I know it's going to happen. When people, it's very dangerous when you think that way, that you think it's going to happen no matter what, and you use leverage. Don't be surprised if you go bankrupt. Like, seriously, because that happens. I see way too many cases. The market goes down hugely like this because you see margin calls. Because a person who bought with 2 times the money that they had, and when those positions start to decrease in value, the broker starts to become nervous and starts to, bring the bat and say, all right, buddy, you got to pay up. And when it comes to go down, they know you can't pay up. They're going to sell your securities at a loss so that they won't induce more losses. And hence, you were left bald. And you were left with no cash, left out of the game, and missed the bull run later. That's the problem with leveraging. And so many of these people are optimistic about bond prices, even though it wasn't with stocks, but with bonds, and let the stock market go down. You see, because it's irrational. Nothing to do with companies, but just because with bonds, people start to think that, okay, stocks are dangerous. So people don't understand finance. That's why I like finance in a way, because it's competitive, because many people are trying to outcompete the other. But the way how to stay super well in the markets is to be unstupid as possible. In the markets, you want to try to be the least stupid amount as possible, because if you do, it's not that hard to compete against a very smart person. Because usually a smart person in this stuff, who overestimates himself, tends to lose a lot of the times. However, I like a saying that Charlie Munger says, like, usually you never want to underestimate the person who overestimates himself. They could occasionally make a big loss, but they can occasionally make a big home run. That was Steve Jobs and that was Elon Musk. And I completely admire those people. They do a really well job in what they're doing. But in the markets in general, you want to try to avoid the most stupidity as possible. And that's how you can make a lot of money in the markets, by being as unstupid as possible. If everyone is entering into one area, you're not going to enter into there, because it's highly likely to be overvalued than what it's actually going to be. And you want to ignore your neighbors, your family, and many people talking about it. And you're going to get very heavily criticized about it, because people think that you're old school, you're a dinosaur. But, you're going to be happy about your decision, because a lot of them are going to incur losses in the long term, and you're still going to be very profitable. And many people are going to think of you as a oracle or a genius out of that. But it was no such thing. You were just trying to avoid stupidity. That's what Warren Buffett did in these ages. You know what Warren Buffett did during the late 90s? He didn't invest in companies that much. You know what he was doing for 3 years, ever since the .com? He was just playing poker. He was playing poker with Bill Gates for 3 years consistently. He got good at it, and he wasn't looking much at the markets that much anymore, because he knew the markets were extremely overvalued. He wasn't getting that much good deals. And you see the mentality there. Can you imagine the amount of criticism that he was getting, because they saw him as a dinosaur, not investing in all these technology companies? But you want to know what happened years later when the .com crashed and all these companies crashed? A lot of people went bankrupt. He was making a 200% gain when everyone was losing money. So how do you think many people thought about him afterwards? You see, that's why you need to stay away from the crowd. You need to sustain criticism. You need to sustain people really thinking that you're stupid. But in total, you're trying to be as unstupid as possible like them. And that's why there's that saying that, don't worry, you'll agree with me, because you're smart and I'm right. I love that saying, because it's really true. It plays in the markets. That's what happened in the bond market. Throughout much of Europe, long-term interest rates were nearing 30 lows, France and Germany's rates being even lower than the US at the time. Investors were leveraging prior to the crash. However, some financial analysts in the US had forecast a hike in the yields of 30-year Treasury bonds, which would be prompted by the Fed raising interest rates to combat inflation. You see, there's always inflation. There's always deflation. There's always inflation. There's all of these macroeconomic metrics that happens in time. But this is what I'm telling you. Markets go down. What are you going to do? Are you going to sell? Well, we've seen that 90% of the times when you sell, markets go up and you end up incurring a loss. So you want to be a bullish. That's the game here. You're going to be losing a lot of times if you short. But I know people, and not a lot of people, but I know, for example, Michael Burry. He's an iconic, most of all because of the movie, Big Short. But Michael Burry likes to bet on the downside of companies. But I think that's a very black and white and a very hard and unnecessary game to do. It doesn't mean that you shouldn't do it, but I'm just saying that in the long term, if you're an investor, I'm just saying for you, an investor, if you're an investor, you shouldn't really be shorting the markets when net in total it goes up more. And it's so much more easier to do that. If you're shorting the markets, you're basically betting on a company to be worth less, right? And there is a lot of companies to do that. But you'd be surprised certain times how unprofitable companies can somewhat squeeze their way in this. And this is a perfect example. During this time, you could, if you had this mentality, but let's say you were a predictor of a certain case, you would say, there's a lot of these stupid, unprofitable technology companies. Why don't we short one of them when it goes up very high? You can do that, but sometimes when you short something, for example, here, when you're so certain it will go down, what ends up happening? It keeps going up, it keeps going up, it keeps going up. And plus the problem with shorting, you can actually have an infinite loss because the amount the price can go up is infinitely. The price can go up from 1 to 100 if it wanted to. But if it goes up, if you buy at 1, the max you can lose is 1. That's the problem with shorting. And that's why I never short anything for investing. I short things when I'm trading, but that's why it's trading. I do the short term. But I never short a company because it's unprofitable and I know that would do bad. Like, I think I don't like to do that. I think that's helping a bad company to be worse. I just don't like that because I'm not helping people. I don't know. I think that's a personal point. I like to help economically. I like to boost activity. I don't like to bet that a thing will go down and I do that with trading, obviously. But like, guys, net in total, these companies make by net somewhat market makers, and they're able to liquidate in some portion. So they are facilitating. It's important to that. But when you're shorting in the long term, you're also betting against the company. And I think it's just, I don't know, it's uncomfortable. I don't think it's a great way to go through things, but that's personal preference. But stocks going up, that's a problem with it. A bubble can last a while, and you don't know when it will burst, but it will happen eventually. And during these times, can you imagine the criticism of Warren Buffett got when the stocks were going up and up and up? But he knew it was irrational. He knew that it wouldn't last for a long time. It was this crazy amount of irrationality in buying. Just to go back to the bond markets, because I went ahead of myself, there was a lot of junk bonds issued by corporate sectors, had earned upgrades for the first time since 1980. Those had been downgraded, actually exceeded those by more than 110 billion. And by the fourth quarter of 93, a higher rate of expansion at 5.9% was raised among some of the over prospect of an overheated economy. Again, very macroeconomic points, but you can see that most of all the cause of this was high leverage in bonds and too much expectations that interest rates would go down and underestimating how inflation would occur. And everything compromised it. Inflation went up, hence interest rates went up. Bonds went down because when interest rates go up, bonds go down. And people incur market security, and if everyone's leveraged in bonds, remember what I told you? When markets go down, the broker's going to sell all of them, which are margin calls. And that's why many people lost in bonds. You never want to do that. But at any rate, you have everyone buying computer companies that are called .com, which is the .com bubble. I mean, if we look back since 90, of course, it's a great invention. I'm not criticizing computers. Like, computers are sophistically one of the best things that's happened to the human race. When it's delivered in rich access, when everyone thinks it's going to change the world, you get a lot of immoral pyramid schemes that happen and a lot of irrational behavior where people like to pound their emotional and don't like to think now. And that tends to happen now more because of social media, because people like to get the euphoria of this dopamine of thinking that they're right, or emotionally that other people like to hear that other tell them that they're right, rather than they know their facts are right despite other people not agreeing with them. You see how the world works with that? You want to avoid that. And then by 2000, the Dow Jones didn't get affected as much. But what did get affected was the S&P, because the Dow Jones in that time had more industrial companies and more, to be honest, conservative companies. It didn't have all these unprofitable companies. Remember, the S&P 500 is 500 companies. It has more companies, so it can fill a lot of these companies. But it doesn't mean that a lot of the companies in the S&P 500 were unprofitable. In fact, there was companies like Microsoft and Apple. I don't know how Apple was doing at that time, but let's say like Microsoft. Microsoft was a good product, it had product value. But even when there's a good product value, that's what happened with banks. That's what happened with Bank of America and JP Morgan. After the Silicon Valley Bank recently, every banking, anything that had to do with finance went down, even though they were making more money, because people like to generalize. Because people don't understand what they know. So when they don't understand what they know, they generalize what they see overwords and they sell all they have because they have a fear of losing money. That's not a fear to be induced at all. There's nothing to be worried about. But people don't like to think. People like to react in what they have. You want to respond, not react. So you never want to be emotional to that factor. You need to see things with logic. To numbers. Numbers don't lie, but people do. You can see here that 2000 went down. But you got to have that mindset. Despite the crash, huge crash, because everyone was involved into this. I mean, it was crazy. Many people were involved into this. Worse than cryptocurrency. I mean, I'm going to be honest. This was worse. I wasn't born, which is funny. I'm pretty young, but I wasn't even born in this time. I have an older sister, and that she was a baby by this time. But many people were betting on computers, which I would be betting. I know, and that's the same thing with cryptocurrency. Cryptocurrency could probably change the world, but it's delivered in rich access. I'm not betting on Bitcoin or none of this stuff, but I know it's like airplanes back then. Airplanes will play a big role. I'm not gonna buy every airplane company because I know they don't have a value there. And when it comes to cryptocurrency, when it's just a currency, currencies don't have a value, especially cryptocurrency. But I don't even want to talk about it because I'm gonna offend people. But the price will go down, kept going down, and during these years, a lot of things happened. The dot-com bubble burst, prices went down. During 2001, you had Exxon, and we can also look at the historical employment. We can see how things were going on even in the dot-com. So during 2001, unemployment was at 5.7%. So of course, because there was still a lot of employees working for these software companies, and many of them were unprofitable, or not software, but just anything that was revolved around .com, really. And just any technology company that was unprofitable and doing these immoral practices to get this venture fund and having no value whatsoever, like a pyramid scheme, really, where you look at a person like Bill Gates, like this was really going on. You had a lot of nerds. A lot of these nerds like Sam Bankman-Friedman, this crazy hair, people think that he's a genius. Reality, he's a scum. No, like really, like what he did was terrible, harmed a lot of people. But a lot of people were like that in these ages where they looked at a lot of tech nerds, and these tech nerds took advantage of these irrationals, and they sold them junk and told them that it was fairy dust, and people believed it, and they used the funds like a pyramid scheme, and they took the profits out. But of course, a lot of people went to jail for that, and that's what happened. And a lot of companies were involved into that, but many of solid companies like Microsoft wasn't. Remember when I said people don't care of facts, people care of what other people are saying. That's just how the world works in the short term. So what happens a lot of times, people do good things, they're unrecognized because they're not popular. That's why you got to watch out for popular people, because just because they're popular does not mean that they're right. Just because someone's famous does not mean that they're right. Neither are they a good person, right? It doesn't mean that they're a bad person, but you have to really see the person for who they are in reality. Inflation was not a problem in these times. GDP went down, obviously, because these companies were comprising revenue, but not an extreme red signal. Unemployment went up, not by much, but unemployment obviously because of this unprofitable companies in where people thought they were going to change the world, and they weren't. It was just a pyramid scheme, and it went down. Also, I just remembered in 1998 there was this. It was the biggest hedge fund. It was one of the biggest hedge funds that went under. And I want to talk about that too, because that's also important. In 1998, there was this firm called which was hilarious. It was called the Long-Term Capital Management, long-term. This fund was actually, can you imagine? Like, this is such a great example of how stupid and why you should not follow even a high reputable company because people think it is. It got to the point that they were awarded a Nobel Prize by economists. I mean, can you believe that? And it blew up. I mean, everyone was putting money into this fund. And what happened later? 1998, they went bankrupt. Biggest hedge fund in the world who won a Nobel Prize went bankrupt in 1998. And we'll see why. This is why you shouldn't follow what people think. It was a big hedge fund. This is why I don't like to be honest, this is why I don't. And I don't have a problem for people who live there to do, because maybe it's a different goal. This is why I don't need to live in New York. I don't need to live in Manhattan near Wall Street, because there's a lot of junk being sold in Wall Street. They're facilitating a game in where they're not making money from returns on their investments, but they're making a return by selling you an expectation to make a return. So they're selling you useless information. So LTCM, I'm not, again, to think that I'm trying to change your chip for you to understand that even a very high reputable company will do stupid things. This is why I like to buy companies that have product that can stand mismanagement. There's a lot of, not all of them, there's a lot of good companies on Wall Street that do right things, but there's also a big majority of companies in Wall Street who do stupid things. And I see that more now because unfortunately in this generation, many people want to get money by doing stupid things, which is involving things that don't have intrinsic value and trying to find the ways to facilitate as much commissions as they can and mislead people. and that never works in the long term. In a bank, you want to look for something solid that will make a return over its practices, not by selling one product and selling it at a lower price completely so they can focus on their competitor. No, I want a company that focuses on its customer, like Amazon, what they did. So LTCM was profitable in its heyday in the 90s. They drew over $1 billion of investor capital by comprising what was an arbitrage strategy would yield huge returns for investors. But the problem was that LTCM was a stupid fund in where they were highly leveraged in a trading strategy where they invested a bunch of money into Russia. Many of you who don't know, exactly in that year, Russia had a debt default where the Soviet Union collapsed because a lot of the Soviet Union banks and economy was a turmoil. I mean, this is now a completely different topic, but Russia had a huge debt coming out. Their system wasn't working as they thought it would, and that forced them to get out of the Soviet Union. And from this effect, that made a terrible consequence to people because people were paying for it. It was like Venezuela. In order to buy some food, it would have costed a huge amount of money, and there was a lot of people starving. I mean, can you think about the biggest power in the country about a decade ago is facing almost famine or having jobless? See, this is why, and this company was involved in a lot of investments in Russia because they were betting on one thing. And when Russia defaulted in its debt, that made the U.S. government literally have to step in this fund because they were the biggest hedge fund and had to bail them out from preventing a economic crisis, similar to like the Great Depression and in '08. Ultimately, a loan fund comprised of a consortium of Wall Street banks, and that was created to bail out LTCM in '98 and enabling it to liquidate in an orderly manner. So there was a fund of loans by a lot of Wall Street banks and they made this fund in order to LTCM to bail out. Because think about it, if you're a bank and this big hedge fund collapses, that's going to affect a lot of the management that you have because they're a big liquidator in that investment. That will affect everyone else's game. So you want to make sure that you want to bail them out so it won't play a big impact to your own operations. And that's what they did. So LTCM was widely successful. Again, we already read that. And the strategy that could take advantage of temporary changes in market behavior and theoretically reduce the risk level to zero. See how stupid that is? Like, you see, this is why you shouldn't listen to what the words say, but the facts. Just because someone says that that has no risk does not mean that it does not have risk. You have to look at the facts yourself and look at it if it actually doesn't have risk. That's why in this game you can't follow the crowd. Because look at what they did. If you put money in this company, you would have lost all your money because they were highly leveraged by betting on one thing. You never want to invest in a type of company that does that. I mean, that is not. I mean, think about it like this. I always see investing like a marriage. When I invest in a company, it's like investing in your partner. If you invest in a partner that likes to drink, that likes to gamble, that likes to get angry over things, in this case, if you like to invest in a partner that's a huge expectations about, let's say, I don't know, some health portion that will happen next year. And let's say that this person is highly volatile in where if they don't get what they want, they completely change and they become abusive towards you. They start to really physically abuse you. Do you really want that person in your life to be this crazy behavior person to be? No. And if you do invest in a person like that, you got to deserve the results that you get. And where if something like this happens, where they fail in their prediction, it will affect your life and it will affect your mental life and where you will suffer consequences for it. And you deserve it. That's why I love the scene that Charlie gives in where the best way to get what you want in life is to deserve what you want in life. And it's such a simple concept, and there's no other way. How can you get something without deserving it? So in order to deserve it, you have to work, do the necessary work that you're supposed to get the normal results from the work, meaning that if you want to get a six-pack, you want to get good biceps, a good body, you need to go to the gym, not every day, but you need to do it in a smart way, meaning that every workout you do it to the fullest, to the fatigue, and you let your muscles break and do the efficient recovery and eat healthy, but not religiously as in nutrition. You see, it's having this balance, but it's doing the work. Many people aren't going to do that because they don't have the goal and the vision to do it. By that nature, you're going to deserve what you want because you did the work. That's the mindset you have to have. If you want to make a good return, you have to do the work that's necessary, that was normal to get to the return. Many people like to have this fantasy because they want to. That's why many people bet in the lottery, and that's why many people buy so many courses when that's not, a course is not going to make you, I'm going to say this right up front. And I know I'm selling a course, but I'm It's not what I'm giving you right now is not going to make you a millionaire if you don't perceive and change your understanding about it. If you really factor into what I'm saying. Why? Because I can't change what you're doing. That's just not the way how the world works. I can't change the way how people think, and I can't change the way how you think. Neither can you do that with me. All I can do is guide you like a coach. That's why I love the best example. What I do is is like a coach. I could try my best to guide you the way, but it's up to you to really do it, right? And that's why many people, unfortunately, even receiving the information that I might give you, some people I know are not going to do well because it's not me, it's them, and they're gonna hate when I say this, but it's real life because it's a problem not with me, it's a problem with them, and that's the same case with me. When I have a problem with someone, it's not because of them, it's because of me. Why should I have a problem with someone, right? There's no reason. I'm making the problem. I'm making it bigger than what it is, right? And that's the way how life works. If something bad happens to you and you suffer for it, you're the one to blame for it. A lot of people are not going to think this way, but that's how the world works because you make yourself suffer for it. If your parents were abusive, it's not their fault. And I know a lot of people are going to hate that. But and what the parent does is not, it's something bad that they did. But just because you suffer, it's not their fault. It's because you make yourself suffer. And I know that's easier said than done. That's harder. I know that. I have people who I know very close who've been through that. And that's easier than said than done. But I guarantee you, if you ask everyone who went through this consequence in their life, and they really be critically, brutally honest, they will tell you that they made themselves suffer because they made themselves too, not because the other person did. And that's the way how it works. That's why if you look at Stoicism, I remember I read something where like, when you die, you shouldn't beg. You shouldn't beg to die and start crying. Why? Because it's just, what can you do? Like I remember there was a saying where, sir, you're gonna break my arm. Sir, if you keep bending my arm like that, you're gonna break it. You're about to break it. Stop. You're gonna break it. But a lot of people scream and get extremely emotional and put that trauma for the rest of their lives. I've faced a lot of death in my personal life, and I learned a big lesson from what I'm basically saying, that everything happens for you, not to you. The world is revolved around what you conceive it to be. If you think something is bad, it's going to be bad. If you think something's going to be good, it's going to be good. This is very simple, but that's how the world works. That's why many people become successful, because they envision themselves successful, because they believe they are successful. That's why I tell to many people that if you're around negative environments, and that's easier said than done, but it's just the way how it is. If you're around negative environments and you let that influence you, don't be surprised if you always get the same results like that other person, because there's no way to scale quantumly to get a better results to change your life if you're around people who do terrible things, who are abusive, like to drink, like to smoke, you see, all these type of things. You have to really change what you're doing. You have to change what you're in overall. But at any rate, this all revolved around this capital management, and that's why they collapsed. But they didn't collapse because, many people didn't lose their money because of this management firm. It was because of their rationality to only look that everyone was getting into this firm, that they didn't even bother looking at the statements. And for those people, they always deserve to lose money because they didn't bother in doing the work that was necessary, despite the euphoria, the emotions, the dopamine, the cocaine, right? Because dopamine's like cocaine like that. It's the same damn thing. That's why you need to have discipline into this. But what helps a lot with what I have is I like what I do, even though it requires a big amount of discipline from out of other people. But I think I have that by nature. I don't follow the crowd. I've never followed the crowd. I'm always the weird contrarian outside that many people criticize. And that's why I'm very fitting to this, because I'm just like that by nature. If you're not, that's why I said the best thing that you can do is invest in an index fund. However, I do advise you to try to change the way how you look about things, because it ultimately is you. It's not me. It's you that's doing all this stuff. I learned this a long time ago, and I'm very young. I don't know what the age group is doing from this, and I think many people might get inspired from what I'm saying from this, but that's how the world works. And that's the same case that I look about it. A lot of people call me very intelligent, right? Because of how young I am and the things that I'm doing. But what I do is not intelligent, but I see it to be normal. If I have something around me in my hands, I would be a complete fool if I don't use it to my advantage. And that's how I see about everything in life. That's why there's a saying that says that if you were born poor, it's not your fault. No shame on you. But if you stay poor, complete shame on you. Because you always had the opportunity, no matter where you're born, to excel and to break out of that. You have to be that person if you want to be successful. That's what it takes. But at any rate, back to the markets. That happened to that fund. Then by 9/11, you had in 2001, the markets went down more by September 11th. But look at this. In September 10th, the market was open. And that was, well, let's see, 8:31. Okay, that was Monday, Tuesday, Wednesday, Thursday, Friday. Okay, that was Monday. Okay, Monday, so Monday 10th. Okay, so September 11th was on a Tuesday. And the market closed for 7 days straight. Obviously, because that was the World Trade Center. I mean, that was the World Trade Center. It collapsed physically. A plane crashed through it, two of them. And of course, that was a terrible event. I wasn't born yet, which is hilarious. I was born the next year after the market bottomed. I was born here, around here, and I was born at the bottom. The market went up. But at any rate, look at this. This is called a circuit breaker. So a circuit breaker was started in the 80s when there was computer traders. And it was because when there was high amount of activity from selling, it's very dangerous because if brokers, sometimes a brokers is like a bank. They leverage their funds. But when everyone, this is what happened actually to FTX. There's a huge problem. This is why you don't want to invest in things that are not regulated by the FDIC, especially in currencies. And that's what happened. When the marketable securities went down and it wasn't able to offset to get back the money people wanted to deposit from the circulation, that brokerage might go under and go bankrupt. And that's exactly what happened in FTX and many companies. But in the markets, they're to avoid a lot of this potential collapse with a lot of brokers, there's something called the circuit breakers. In order to stop trading, in order to stop the markets for a set period of time until it stabilizes itself. Right. So when a circuit breaker happens, it doesn't mean that your sell orders that you did are completely stopped and you can't sell anymore. It just means that the sell order would be executed until the circuit breaker is stopped. And that happened, and the circuit breaker was stopped until September 17th. And I completely understand that. I mean, we're talking about an event that a plane crashed in the World Trade Center it was a terrorist attack that would create a big amount of selling. But look what happened afterwards. Despite the selling for a week, the market bottomed and shot back up. See, I'm pretty sure no one would have expected that a week later the market would bottom temporarily and shoot back up for the next until the year ended for a rally. Of course, the market went down more because of these unprofitable companies and Exxon involved as well. Many different reasons. But that goes to show that you can never predict what happens in the short term. Until the market bottomed hugely, completely went down sharply from this time, and it shot back up here and it went down. And I'm telling you, in this time too, did you really think? I'm pretty sure everyone who sold here had no idea that the market would bottom on this day and it would completely go up for the next few years. See, that's why it's unpredictable on that aspect. That's why I always buy when there's a crisis, when the price is going down, because I know that's not going to last long. And I can never predict the bottom, but I can always be around the area of the bottom. And I know I'm buying at a cheaper price than what the price will be later. So I always make sure to have cash when the market's going down. And you always want to do that. And in order to have cash, you need to spend less than what you earn. It's basic common sense. And you need to save what you earn by investing, not saving it in a bank account, not saving it in nothing, but saving a portion and investing it. Investing it in the stock market when the prices are low, investing in properties, all these things, not investing in things that don't have any intrinsic value.